Thank you so much. I am Liz Lumley. I'm deputy editor of The Banker in London, and we have a fantastic panel for you today. We're going to be looking at shaping the future of investing. And I ask for apologies in advance. I am a common American, so I might butcher some of these names, and I do apologize. We have Naeem Abu Jadori, CEO of Cadrium, Jenny Johnson, president and CEO of Franklin Templeton, Luke Ellis, CEO of the Man Group, and Emmanuel Jacquelot of the CDPQ in Quebec. Thank you very much, everyone. So I'm going to start off with a question for everyone. Technology constantly changes, our world, our society, financial services, and the investment world is not immune from that. However, as you saw from the last panel, we're going through a lot of change right at the moment. We're coming off of a global pandemic. We have a global energy crisis and a cost of living crisis, and we have war in Europe. So it kind of feels like this is a different era, a different type of change than we've seen in the past. How, what is the biggest economic risk we're facing right at the moment as an industry? So Jenny, I'm going to start with you.
Well, I think in the kind of immediate term, I think the market is underestimating how aggressive the Fed wants to be and how sticky probably this core inflation is. And so I think that Chairman Powell yesterday was trying to make a point following some comments he had made that were perceived a bit dovish about a month ago, that, hey, we are going to make sure that we have inflation under control. He's reiterating his 2%. I think that's a hard target, and that he doesn't see rates declining in 2023. And so, yet the market doesn't seem to be reacting and actually taking those seriously. The Fed has a credibility problem at the moment.
Mm-hmm. Interesting. Yeah, Luke, I'd love to hear your views.
So I think all the central bankers have a credibility problem. Powell was just yesterday's one. I think we'll have a local equivalent this afternoon, and the UK, maybe he's just done it and had the same problem. That we have a significant inflation in the world. We've lived through 10 years of maybe the easiest investing world you'll ever see, where you could buy absolutely anything and it went up. And you could finance anything and you could finance it for essentially nothing. And I think history will say that 10 years was very strange. And now inflation is out of the bag. We're going to have either central banks who really do enough to get inflation down to 2%, but that's a really significant recession. That's a doubling of unemployment. And there's a lot of pain in that. And I think part of what the market's saying is they think that the central banks will chicken out, and I suspect they will. I mean, the amount of pain required to get back to 2% is very significant. If they don't get to 2%, we're going to live in a world of heightened inflation, 3 to 6% inflation range, which I suspect is what we have for the next 5-10 years until someone in the central banking world does a Volcker and says, I don't care. But you forget, it took 15 years from the beginning of inflation last time before Volcker came along and did whatever it took. So I think we're going to have a very different investing regime for the next 5 or 10 years, and financing things going to be difficult, and markets are going to be volatile, and sort of just sitting and holding the same thing isn't going to be the right answer. And I think the big investing challenge is people aren't prepared for that.
I see. We might have a few more comments about central bankers on this panel. So, Naeem, I'd love to hear your views.
Beside inflation, I think I'm less pessimistic. I think inflation is starting to peak down, and it's going to be contained in the coming 2 years. I don't see it at 6%, but clearly it's between the trade-off, how much the central banks are going to tighten, and are we going in a soft landing or hard landing? I see more a soft landing, and I'm on the optimistic side. But for me, there is another big risk that is more worrying me. It's the food and energy crisis today that we have, and impacting the cost of living, not only for the poor, but also for the middle class. And clearly the social disruption that was already here is accelerating. And I'm really worried about social unrest and risk of starvation in some countries in Africa, part of the Middle East. And all this has to be managed, and with the high level of debt that we have today, it's going to be challenging.
It's interesting that you said that. I think that's true. The economic risks we're facing right now are hitting the middle classes, which is something different. So, Emmanuel, I'd love to hear your views on what's the biggest economic risk right now.
Oh, I'll add to what Claude said. I think the last 10 years were quite a nice era to make investment. But I'll add the last 2 or 3 decades were also a nice era in terms of geopolitical risk, in terms of global trade. Everybody knew where global trade was heading. And frankly, we're calling a recession next year. So we have to get ready for that. But what I'm concerned about is what are we coming out into after this recession? Because we feel it's going to be a slightly different paradigm from what we've experienced in the past. And that's what's, I think, the risk as investors we need to get prepared for. And, recession comes with value destruction, misallocation of capital, social unrest, like Naeem was mentioning, social, consequences of these value destruction. And I think being a long-term investors, that's where we can make a slight difference, investing in those companies, helping them through the crisis, helping the communities in which they are present, come out stronger of the recession.
So social.
Gosh, it's very striking. The last panel, the last question, they were all optimists. And we sound quite depressing between us, but maybe we're realists.
Social unrest, unemployment, and central bankers that aren't ready for what's going on. So yeah, let's see if we can have some hope by the end. But Luc, I wanted to go back to you because I was interested when you said that the past 10 years have been a very easy investment environment. We are now in a different economic environment. How have the investors themselves changed? Are you seeing new demographics, new, priorities or risk appetites? How have they changed?
I think we're in the middle of a change. So I think Jenny can talk a lot more than I can about the retail world, but it was clear that particularly in the US, we pulled a new generation of stock market investors into the stock market with their furlough checks, and mostly they've all wiped that out in the course of 2 years. So I worry that might put them off for a long time. But sort of from the big money flows in the world, I think the big transition we're seeing is corporate defined benefit pension plans used to be the largest investors in the world, and they are rapidly disappearing. And the ones that are left are mostly invested in very boring non-growth assets, which is not necessarily a good idea for long-term savings, nor for the sort of deployment of investment capital. And so that where you're getting now is a combination between people like CDP that are public pension plans who continue to be able to invest with a long-term perspective, pension plans or sovereigns, or it's not much difference between the two, and then retail where or individually directed savings where it's really important that they're getting the right advice to help them through rather than the one that's easy for the investment provider.
So Naeem, I'd love to hear your views on how you've seen in the kind of behavior of investors change.
I see 3 trends, in fact, that there is an acceleration of the trend. The first one is on ESG, coming from the new generation, the millennials and women who are starting to really willing to invest with purpose. And the turning point, the acceleration started really after the COVID, where they want to invest with, express their social values and with a positive impact. This trend is here, and it used to be institutional, and now it's more retail wealth management. The second trend is in private assets. It was more institutional, and it's moving also to the wealth part. And the third trend is digitalization. It was here, it's accelerating in the last 3 years. We are changing our way of working, way of investing, and way of serving our clients through digitalization. And really, these 3 trends are here. The risk and is there any risk? We feel the stress today for investor very high because of 2022 and the situation going on. But the reality, we don't see panic today in the market. We don't see panic in terms of outflows. And if we look at the outflows in Europe, just for the three first quarter of 2022, they are less important than 1 month in March 2020. Then it shows that people and the investor are still holding well and not panicking.
That's good. That's a bit of hope, not panicking. So, but I wanted to maybe move on to talk a little bit about the role investment community has in climate change and social inequalities. And, you know, what are some of the strategies that can be used to accelerate investors' involvement in ESG investment frameworks? And Emmanuel, I was going to start with you on that one.
That's my favorite topic. I think I'll share with you one kind of a large-scale experiment that we did in CDPQ back in 2017, precisely on sustainable investing. We decided as an organization, and we were the first institutional investors to do that, to give ourselves carbon targets for the entire 300 billion portfolio that we manage on behalf of 6 million Quebecers. And we came out saying we want to measure our carbon footprint, and we want to decrease that by 2025 by 25%. Good news, 4 years later, in September last year, we had beaten that, and we came up with a new target to decrease by 60% by 2030. How did that happen? How did we make it happen? It took a lot of cultural shift, into the organization, and three elements I want to share. The first is we had to change our people's mindset. And so to do that, we incorporated, carbon targets into everybody's remuneration. And I think we're among the first to do that. And that worked really well at shifting the organizational focus. Second one is what we invest in. And that's quite obvious for an investors like people sitting in this panel. And we decided to check the companies in which we invest, to check what is their carbon impact. That has good consequences and bad. We obviously stopped investing in some sectors, started investing a lot in other sectors. And the last one, which is the most powerful, I think, is we started explaining to the management of the companies in which we invest what we were looking for, very specifically, helping them, funding them when they required capital. And that's how we can leverage this kind of initiative, is by multiplying the effect, getting leverage on your portfolio companies. And specifically, it helped transition some of these businesses rather than just selling the companies. And I think this is really important to have a large impact as a sustainable investors, is to leverage those portfolio companies in which you invest.
Interesting. So, Jenny, I'd love to hear your views on some of the strategies to be involved with ESG frameworks.
Yeah, I think on the issue of climate, right? It started out and it was scientists and passionate environmentalists, and that was the focus. I think it took COP26 before they actually added a financial investing track, right? And the reality is you need the money to be able to invest to do these things. And so I think that the lesson in that process is, all right, so we need to have the balance sheets, we need to engage. And so as asset managers, we have the ability as shareholders to engage with companies in making sure that their practices are focused for the long term. And I think, to the point just made about initially it was a bit of exclusion, and then people realized, well, I'm not actually making any change, so I need to have engagement. And so I think it's actually an exciting time. And coming from the US, I actually think the structure in Europe of Article 6, 8, and 9, as far as funds management, is really interesting. Although if you talk to people locally, they say, oh, what a mess. It's the regulations are always changing. You're not sure what it means. But the reality is it always takes a little bit to kind of clean these things up. And so I'm very optimistic about, one, the desire of asset owners to make that impact and to think about the climate change and the impact you're going to have, as well as returns. So often those two were kind of separated. Now people are realizing, okay, we have to do that. We have to have that engagement. And then to your question on the D&I, look, the greatest way to create equality is upward mobility. And so as capital allocators, being able to fund entrepreneurs and being able to allocate in a diverse way is a real opportunity. And in the US, less than 2% of venture capital money goes to female entrepreneurs. And they have twice the return of the average venture capital fund. So why is that? Is it because the venture capitalists don't want women to be successful entrepreneurs? I don't think so. I actually think it's that only 12% of VCs are women, and so they miss opportunities. And one example, that Franklin Templeton invested in a company called Rent the Runway. So I was thinking about that process of getting that funded. So you're a woman, you're coming in, you're saying, for women, we can't really wear the same gown to multiple galas in a period of years. Okay, so you got to buy a gown. Now you're pitching to a bunch of male entrepreneurs who are thinking, I've had the same tuxedo for 20 years. I don't understand kind of the issue. And so 54% of women say, when I was pitching my idea, they didn't understand the business case. So I think that one of the most important things about D&I in the asset management business is we've got to get more women, more underrepresented groups making investment decisions, and that will also translate into greater equality.
And also get more VCs that were founders themselves. It's one of my things as well. I want to have everyone have a comment on climate change, in ESG frameworks and climate change and social inequality. So Luke, I'll go to you on this.
Sorry, forget the mic. So look, I think that they're two very separate issues, I think. So climate change is incredibly important for the planet, and we all have to do what we can do to help with it. I think that in the course of that process, there's an awful lot of things that need to get financed. And it is going to be important that there's a sensible return on the capital needed to finance it. And it slightly amazes me sometimes where people talk about the trillions of dollars we need to finance it, and then talk about giving 3% returns on long-term green infrastructure, which is really just not a rate of return on the capital that's going to get you enough capital to finance anything like the problem. And so I could see a number of issues there, which is the long-term financing problem away from the sort of the technical fund management one. I think the other thing I'd say on the topic is on this income inequality, which I think was what you were getting at. And as asset managers, our number one contribution to helping on income inequality is to generate decent returns for our average savers. Now, we'll all have slightly different numbers, but he talked about 6 million, must be 6 million Quebecers. I figure we run money for sort of 60 to 80 million people who are retirees. Somewhere our median typical client, it's not the person we talk to, but the person whose money it is a 40-year-old primary school teacher who hopes to retire in 25 years. And our job is to deliver them enough money at the end of that period that they can afford to retire in a sensible quality of life. That is, I guess if you're in Quebec, it's probably that you can turn the heating on a lot at this time of the year. If you're in Texas, it's that you can turn the air conditioning on in the summer more often. If it's for many of these people, it's really, can you afford heating on more than 1 or 2 days a week? And if you give them better investment returns, they can. But also, it's really important in the course of that, what we don't do is make the world worse. If we, as through our investing, create more climate change, then they need to have the air conditioning on more often. They need to have the heating on more often. And so you've delivered them an improvement in financial terms, but not an improvement in real life terms. And so I guess I think as investment managers, we have a real duty of care to deliver investment returns for our end savers.
Well, my father's a retired primary school teacher, and I'm incredibly jealous of his pension. But Naeem, I'd love to have your views on some of the strategies that you can see to bring people into the ESG framework.
Clearly, we have a role to play as industry, asset manager, pension fund, and investors to facilitate and channeling big part of the asset. We know that we need to cope with climate change 4 trillion per year. We are investing 1.3 trillion. Then the gap is still 3 trillion. We have to facilitate and allocate assets from the financial sector to the real economy. Now, as an industry, we are playing a role by integrating risk and opportunities in everything we do. We call it inclusion. We also operate with active engagement with companies to help them practice for the better. And after, we try to practice what we preach as a company by investing in impact investing and try to evaluate the positive impact that we are having on the industry. We do it as a company by giving back 10% of the management fees on some of the thematic funds to social and environmental projects, and also doing impact in private equity. Now, I would like to maybe the previous panel was talking about the dialogue between private and public. And to be honest, the private sector, the asset management sector has been investing in ESG, but it's not changing. We are not moving fast to tackle the problem of climate, it's becoming really material today. And we need here a clear dialogue between the private and the public sector in order to create the right incentives, the right framework, the right education gap that needs to be for the end investors. And finally, the courage to stop giving subvention for fossil fuel sector and also helping investing in clean tech. Then there are a lot to be done, but it has to be done collectively and globally with a real cooperation between different countries.
So, Neem, I'm going to stay with you because the next question I wanted to ask, I think, is kind of at the heart of changing appetites, changing investment behaviors, and also returns. Are there sectors that you have pulled out of that you no longer invest in?
It's a good discussion. It's about Jennifer was talking about it's exclusion and engagement. What we do is we exclude some sectors that are not respecting international norms, in corporate, in countries as well. But the reality, exclusion is not enough because we need really to do positive selection and engage with company to move the needles. And we need both, in fact, part of exclusion in order to avoid a reputational risk and the downside risk, but also engagement and positive selection in order to move and accelerate the process of changes.
Emmanuel, I'd love to hear your views. Are there sectors that you no longer invest in, and why?
I don't like to go through exclusion lists. We are trying to find solution, but there's a few sectors that we came out clearly. And the latest one, which was the most controversial, being in Canada, was we decided to stop investing in oil production, and we will have terminated all investment by in 15 days, really. Another one is tobacco, and we joined a large alliance to stop investing in tobacco, and we view it's not a sustainable, for health reason. It's not a good use of our capital. And the last one, which is coal, we decided to stop investing in new coal plants 2 years ago, and to try and phase out our investment in coal by 2030. But there it's and this is one I'm quite proud of. We are still invested in some coal plants in I'll give you an example, in Indiana, in the middle of the US. And rather than to sell our investment, we decided to accompany the company. That sounds strange. Accompany the business, IPL, into its transition. And we've been doing that for the last 8 years. And together with our partner AES, we've invested more than $1.4 billion. And to answer we're still making a profit on this. And we're slowly transitioning this utility that was 80% coal to a utility that we hope has no coal by 2025. And we're halfway there. So we already closed half of the coal capacity. And again, it's not just selling the coal plant to somebody else who's going to be happy to operate it behind, away from public eyes. We're actually shutting them down and deconstructing the coal plant. So that's an exclusion that we're taking very seriously, but we're trying to act proactively on.
So I wanted to move the conversation on to one of my favorite topics, which is technology, and how technology and digitalization has impacted the investment process and whether or not it's brought in a new audience. So Luc, I wanted to start with you on that. What impact has it had?
I mean, one of the interesting things is I don't think technology's had nearly enough impact on the asset management business yet. I mean, we are a very technology driven business. I'm sort of amazed as you look across the industry how much is still done in very manual ways. And so I think we're in the early innings of technology's impact in asset management. There is no industry in the world which technology isn't changing. It's just a matter of how quickly you embrace it. The asset management industry, while it has good margins compared to most industries, at the same time has an incredibly inefficient structure. And so, the more we embrace it, the more that we can deliver better returns to end clients. We're obviously at the far end of the distribution of those things because we also do it for making the investment decisions, which is more controversial. But at the same time, I always say, I don't know anybody who still uses a pen and paper to write down their positions. I think everybody uses a computer somewhere in their investment process, increasingly more. And so really everybody's going there. It's only a question of how far you've gone.
Yeah. So Jenny, what do you think? How far has it gone, the impact?
Well, I agree, but you're always kind of on the early stage of the next wave of technology. But I think right now, I think AI for active managers is going to be very significant. I think that active managers are going to have to be as good as Google is at being able to get insights from non-traditional sources of data. And it's going to be managers who have access to a broader, deeper set of data that's going to be able to and knows what to do with it. It's going to help them improve their investment decisions. I think that the technology is enabling a whole other level of customization that will both have benefits around understanding non-traditional risks in portfolios and allowing clients to express their personal preferences. So we invested in a company that will essentially allow us to take our active strategies, present them in separately managed accounts in a much lower, it used to be you'd have to have $1 million to be able to have a separately managed account. But it'll take these levels down. I mean, eventually I think it's $10,000, $5,000 accounts. And you're going to be able to have an active strategy expressed in your portfolio being tax efficient and tilted towards whatever your passion. Maybe you want gender equality, maybe you want net zero, and it's going to be able to be expressed in that. And so I think that that personalization is just going to be taken to a whole other level. And then finally, what I always say is blockchain is the greatest distraction from the greatest disruption that is coming to financial services, which is, Bitcoin is the greatest distraction, and blockchain is going to be really significant. It's going to drive down costs in the back office. We're going to see new investment capabilities, and it's going to bring private markets to really democratize private markets.
I'm glad you brought up blockchain because we were talking about technology and it's the law that we have to move on to a blockchain conversation. So but what are your views about the rise of digital assets and the use of blockchain in the investment sphere?
So FTX, right? Everybody's like, oh, that's it. See, I told you it was a terrible thing. FTX is a centralized exchange. What is interesting in blockchain is the decentralized nature of it. Had FTX been built on a decentralized exchange, all of those transactions that started to be done between the two entities, FTX and Alameda, would have been exposed. And so, if you think about there actually been real beneficiaries, Uniswap, SushiSwap, those are decentralized, meaning that there are a bunch of programmers out there who are programming and you have tremendous exposure to what the underlying. So I actually think there's more visibility and transparency in this space. If you think of what blockchain does is it reduces the frictional cost of a transaction. So there's a lot of intermediaries who are going to be threatened by that. And so they're going to want to slow it down. There's a Four Seasons, and I think it's in Aspen, where you can own a piece of the Four Seasons with your token, right? And so in theory, they haven't executed it this way, but you're starting to see people do it. The title, you're not going to have to go to a title company to transition that asset, that property asset. I can just sell it to you, and immediately you know that you have a good title to that. So think about how that opens up real estate transactions. And then the other thing is this Ethereum change from what's called proof of work to proof of stake, I think is underappreciated. Anybody who's run a technology department knows a massive technological change. This was a massive technological change done by a bunch of programmers kind of working together, crowdsourcing, and there was not a single hitch in it. And every business that was built on Ethereum benefited from this massive change without having to put up a single dollar. And so the kind of the nature, if you can build your business on top of these platforms, you actually get the benefit of a lot of technical energy being put in that you don't have to pay for.
No, really interesting. I think the best description of FTX I heard was it was acted like an unregulated bank. So I want to move on to talk a bit
Can
about.
we
Which one? Yeah, please get your view.
Slightly just to give the alternative case, because it's a nice idea. You get your NFT on a piece of the Four Seasons in Aspen, but we have that technology. It's called a closed-end fund, and they all trade at a discount. And if you own the whole of the Four Seasons in Aspen, then you can sell it. And if you own a piece of it, you can only sell it at whatever discount somebody will buy it from you. And those sorts of things where we try to create liquidity in something which is inherently illiquid end up being to the disadvantage of the early movers. If you look through financial history, and one of my, I sort of love the intellectual part of the technology on these things, but every time I look at actual use cases, I don't see that they, sort of to get to where, it would be great if all security transactions were done on a blockchain, would take a load of sort of reconciliation processes out. The AEX, is that right? Yes, Australian exchange just blew 300 million Aussies, I assume, but in what's been an 8-year, I think it was, project to try it, and they could just never reach critical mass to make it actually work in a real use case as opposed to an intellectual one. So
can I respond with it? So fair point. But now imagine that ownership that they're, so it's not a closed-end fund in that you have a bunch of combined assets together, right? But I own a piece of that Four Seasons. I get paid my revenue, right? Or my like dividend. But when I check into the Four Seasons, they know I'm an owner, so I get a room upgrade. It's a loyalty program that is tied to your equity ownership. So yes, you're right in that many of these types of the technology exists to do many of the business cases that are being built on blockchain, but it takes out the costs and makes it more efficient. And so if you think about Web 2.0 allowed you to unlock, to monetize the value of some big assets like your house with Airbnb or your car with Uber. What blockchain will allow you to do is actually take it to the next level. So there's a company where you can sign up with them. There's a 2-year waiting list where the excess capacity in your home router is essentially sold to them and they pay you that. Now you're just paying your same monthly rate, but you're suddenly getting a source of income that you wouldn't be able to get unless somebody gave you a way to unlock it. And I can give more examples, but it's going to take this concept of being able to monetize some of the assets you have that are locked up today simply because it drives that frictional cost out.
Very good. Should have had more questions on NFTs. So I wanted to move on to a little bit about M&A and the M&A landscape right at the moment. How it's kind of changing the investment sector. So Jenny, actually, I'll stay with you on that on your views.
So we've done 8 acquisitions in the last 2 years, and the focus has been for us recognizing, one of the things that comes out of sort of the easy money environment of the last decade is, and the regulatory environment, is the reality of the growth of private assets. And if you look today, there's half the number of U.S. public equity companies. Private credit's not going away. banks' capital requirements are such that they're preserving their capital just for their best clients. And so it's created this entire industry in the private credit space that continues to grow. So we looked at it and said, we have to be able to offer that to our clients. And so our focus on M&A has been adding capabilities in the private space as well as technology, much of it on the distribution side to help us build. We talked about the customization to help us to customize to the end client.
So, Naeem, I'd love to hear your views on what's going on right now and how the current M&A environment is impacting investing.
Yeah, at our level or at the market, both. Market will accelerate in M&A, taking into account 2022, the difficult and the high volatility in the market, pressure we have on cost today, digitalization, pressure on revenues, regulation, and the passive management are putting huge pressure on the margin of our industry and accelerating M&A in the coming years. We know that it's not a free lunch, M&A in asset management, because it's a people business, and there is a big risk of losing the best talent and being frozen by consultant. Then we have to be careful. Now, as a company, we have been investing in ESG for 25 years in public assets, and we are diversifying our assets in private. We did 2 acquisitions in private real estate, private debt, and now moving in impact investing in Europe mainly, and continuing to look to grow organically, but also external growth, and considering all opportunities in the market today.
So we've got about 5 minutes left, and we're going to tackle the last question, the very small topic of diversity. But hopefully we'll get some interesting. Naeem, I'm going to stay with you because you mentioned earlier in the discussion that there are now more female investors, in the space. Is that what do you attribute to that rise? Were there actions of the industry put in place to increase the amount of female investors, or is this just, sort of demographic change or behavior? Like, what do you attribute to it?
The trend is accelerating. I started in asset management 30 years ago, and when we see the last 4 years, the ESG trend is accelerating really the diversity aspect at all levels, equity and inclusion in all companies. I think gender diversity is key, and today, the average is around, let's say, 35%. At the high level management, it's sometimes lower in average in the industry. We need to accelerate, but it has to be done at all levels. And there is a big interest for us to do it because it keeps talents, specifically the young generation, and it attracts talent when you are more inclusive and more in the diversity aspect. What we are doing, it has to be done on the when you attract people and recruitment, it's retaining people, development and promotion. Then we have to work at all levels, bottom up, top down, and the industry is moving in the right direction. It's taking time. It will take a little bit of time, but at least there are real trends, there are KPIs, and we are challenged by the clients, by the consultant, and by the press, which is great. And we are really glad to see that it's moving. It will take time, but we are going in the right direction.
So I wanted to go to Luc now. I mean, with diversity on all levels, on both the investment side and the investor side, what are some of the strategies to combat it?
So, look, I mean, I would agree with the comments that, when I first came into finance 40 years ago, it was a pretty horrific industry from a diversity point of view on any part. And if nothing else, as you look at the panel today, we've made a step in the right direction, but we haven't got everywhere. And honestly, I think asset management's better than the average in finance, but still has a long way to go. Part of the challenge is, the average people who are the fund managers today have been in the industry for 25 years. People don't give money to 25-year-olds to run. They give it to somebody who's got experience. One could debate whether that's right or wrong, but that's the truth of it. And so we're now dealing with the bad management practices of 25 years ago. And what I think is really important is that we all concentrate on making as many small but positive steps as we can. right? Because there is no one simple thing of saying X or Y and it'll solve, but making as many positive steps. And one of the, the interesting things this year that we've had within our firm is, so, we'd embraced the network process. So we'd had a Women at Man thing, we'd had a Families at Man, we had a Black Employees at Man network. We sort of patted ourselves on the back. They've been running for a few years. They've done some good work. And this year, there's been a veritable torrent of other groups coming forward saying, hey, what about us? In different ways. And what one realizes is true diversity requires you to embrace all people and give everybody the chance to succeed. And it's very easy to feel othered. Clearly, this room is another room where we don't have 50% women, and the planet's got 51%, I think 52% women. So we have further to go. But actually, lots of people can feel excluded in lots of different ways. In the UK, social mobility amongst white working class boys is the number one problem if you look at it by size of group that's being disadvantaged. That's very different in the States. It's very different in France. It's very different in so in each country you have to react to it in the appropriate way. But what we're all trying to do, the more diverse the set of ideas you've got in a discussion, the better the answers you're going to come up to.
So Jenny, I know we only have 48 seconds, but what are some of the big and positive changes you've seen happen?
Well, I think the key, and Luke mentioned it, is we've got to change the pipeline. If I go hire a woman from an investment team from Man Group at Franklin Templeton, I've done absolutely nothing to improve the industry. My numbers will look better, but done nothing. So it's about, and we've created programs with like historically Black colleges and universities, Girls Who Invest. We've got to change the pipeline. And part of that's the narrative that this is a great business that helps people, right? The younger generation wants to be engaged in things that help people. This is the best place to do that.
Wonderful. Well, thank you so much. This whole panel, we could have had a panel on each of our ESG and diversity and technology, but thank you so much for listening to us. Thank you very much.